Property penciled out. Borrower had decent credit. The numbers looked fine to you. And then the lender came back and said no, maybe they declined it outright. Maybe they came back with a loan amount that was so low it didn't make sense for the borrower. Either way, the deal died. If you're coming from residential lending, that experience is disorienting. In residential, you run the numbers through the system. You know what's going to happen. You have guidelines. Commercial doesn't work that way. And the faster you understand why, the faster you start closing deals instead of losing them. Here's what's happening in the market right now. Commercial lending activity is picking back up. The CBRE Lending Momentum Index was up more than 100% year-over-year in Q3 2025. Borrowers are coming back to the table. Investors who sat on the sidelines for 2 years are looking at acquisitions again. Rates are still higher than historic lows and sensitive to Treasury yields, but the uncertainty has eased. The market is open. And every one of those borrowers needs someone who understands how commercial underwriting actually works. That's the opportunity. But I see brokers miss it over and over again for one reason. They either refer it out or pass on it entirely because they don't understand commercial. And the ones who do try to engage apply residential logic to a completely different underwriting framework. Today I'm going to walk you through the most important underwriting concept in small balance commercial lending. It's called the debt service coverage ratio. And if you don't understand how a lender actually uses it, you will lose deals you should be closing. DSCR stands for debt service coverage ratio. But here's something most brokers don't know. There are actually 2 DSCR approaches, and knowing which one to use on a given deal is the difference between getting it done and walking away empty-handed. The first is streamlined DSCR. This applies to SFR 1 to 4 unit properties and small balance multifamily up to 10 units. The calculation is straightforward. Gross rents divided by PITIA. That's principal, interest, taxes, insurance, and association dues if applicable. Streamline is a simpler underwrite. Most lenders require a minimum of 1.00 times, meaning the rents just need to cover the full housing payment. No more, no less. The second is traditional DSCR. This is the deeper underwrite. The formula is net operating income divided by total annual debt service. NOI is what the property earns after you subtract all operating expenses, taxes, insurance, management fees, maintenance, vacancy allowance. Those all come out before you divide by debt service. Traditional lenders typically require 1.20 to 1.25 minimum. So why does this matter? Because on a $1.5 million small balance deal, the approach you choose directly determines how much money your borrower can borrow. Streamline at 1.00 times will generally support more loan proceeds than traditional at 1.20 times, because the coverage requirement is lower. One structure gets your deal funded. The other may not. I've seen that exact scenario play out. Knowing when to use which approach is one of the most practical skills in commercial origination. Here's what residential brokers miss. In residential, you are underwriting the borrower. In commercial, you are underwriting the property. The property has to prove it can pay for itself, with room to spare. For traditional DSCR, which is where most commercial deals live, let me tell you the 4 places I've seen it destroy deals that should have been approvable. Number 1. Borrower provided income versus lender adjusted income. A borrower tells you the property grosses $120,000 a year. That may be true. But lenders don't use that number. They apply a vacancy factor, typically 5 to 10% for stabilized properties, and they verify every dollar of income with leases and bank statements. If you built your proforma on the borrower's best case number, your DSCR is already off before you submit the package. Number 2. Operating expenses the borrower didn't account for. Self-managed owners routinely leave out management fees because they handle it themselves. Lenders add that back, usually 8 to 10% of gross income, because the next owner may not self-manage. If it's not in your analysis, your NOI is overstated and your DSCR is wrong. Number 3. Market rent versus actual rent. This one catches brokers constantly. If the property has below-market leases, tenants locked in at rates from 6 years ago, the lender will underwrite to actual rents, not what the property could theoretically generate. DSCR takes a hit. Number 4. Rate assumptions. In residential you run payment calculations all day. Commercial is no different, but the rate environment matters more than brokers realize. On a $1.5 million small balance deal, a rate move can be the difference between a DSCR that clears the lender's minimum and one that doesn't. Stack that on top of using the wrong DSCR structure from the start and you have deals dying that could have been saved. Here's something I figured out quickly. DSCR is not just a pass-fail test. Lenders use it as a pricing and structuring lever. If your DSCR comes in at 1.20 and the lender's minimum is 1.20, you're going to get a deal, but you may not get the loan amount you asked for. The lender will size the loan based on what the NOI can support at their minimum coverage ratio. If the property can only support a $1.1 million loan at 1.20 times coverage and the borrower needed $1.3 million, you have a gap to solve. Here's how experienced originators solve that gap. First, look at the operating expenses. Are there legitimate adjustments the lender shouldn't be stabilizing? A one-time cost, a vacancy allowance that's higher than the market warrants? Work those numbers honestly. And if there's still a gap, sometimes the answer is the borrower comes in with a larger down payment and you right-size the loan amount. And if none of that closes the gap, is there a different loan product that fits the situation better? Sometimes the answer is as simple as applying the right DSCR structure from the start. Beyond that, bridge lenders will accept lower DSCR on a transitional property with a clear value-add business plan. Knowing the product matrix is how you save deals that a single conventional approach cannot close. When a commercial deal gets declined, 9 times out of 10 the originator either didn't understand the transaction or misplaced the loan with the wrong lender. Knowing the lender's requirements for both the property type and the borrower profile is what determines whether the deal funds or not. Lenders can work with margin. They can't work with mystery. Your job as the originator is to tell the deal's story in the language of the lender. And the primary language of commercial lending is DSCR. Let me give you a real example from my own book of business. The numbers are generalized but the situation is real. Borrower comes to me with a mixed-use building. Ground floor retail, 2 residential units above. Purchase price $1.1 million. They needed $825,000 in financing. Borrower provided income showed a DSCR of 1.28. Looked fine on paper. I knew better than to submit that number without checking it. When I went through the lease docs, one of the retail tenants had a rent reduction for the last 18 months of the lease, something in the original lease the borrower had glossed over. When I adjusted for that, the effective gross income dropped and the DSCR came in at 1.11. At the rate environment we were in, most small balance lenders weren't going to touch it. Instead of submitting the deal and letting the lender figure it out, I went back to the borrower. We restructured the equity. They came in with a larger down payment, brought the loan amount to $740,000, and the DSCR at the new debt service cleared 1.25. Deal closed in 42 days. If you're a residential broker who keeps referring commercial opportunities out because you don't fully understand the underwriting, this course was built for you. It's called the Commercial Lending Accelerator. 49 modules. Practical underwriting. Real-world deal structuring. Coverage of DSCR and SBA financing for owner-occupied properties, and what to do when a deal doesn't fit conventional financing. It covers everything from deal intake to closing, and it's currently available at half price. I'll see you in the next one.